Good morning, good afternoon, or good evening, wherever you are in the world, and welcome back to Macro Shock. I'm your host, Dave, and today we're diving deep into some truly market-moving news that has everyone from institutional giants to your neighbor next door trying to figure out what's next. Folks, are we finally seeing the Federal Reserve wave the white flag in its fight against inflation, shifting its gaze firmly to the job market? Because Federal Reserve Chair Jerome Powell just delivered a speech that has the markets buzzing, and we need to break down what it means for your portfolio. Is the coast clear for a Santa Claus rally, or are there still icebergs ahead? Let's cut right to it. Yesterday, Tuesday, October 14, 2025, Federal Reserve Chair Jerome Powell delivered a critical speech on the economic outlook and monetary policy. The headline? A sharp slowdown in hiring is posing a growing risk to the U.S. economy. This isn't just a casual observation. Powell explicitly stated that the Fed would likely cut its key interest rate twice more this year, with the first of those expected at the upcoming meeting later this month, October 28-29. Powell's remarks, delivered to the National Association for Business Economics in Philadelphia, underscored a clear pivot. The Fed is now seemingly more concerned about the job market's health than it is about inflation. This is despite tariffs gently lifting the Fed's preferred inflation measure to 2.9%. What's also fascinating is that Powell made these statements even amidst a government shutdown that has created a significant data blackout, leaving the Fed without some of its usual crucial economic indicators. Yet he maintained that the outlook for both employment and inflation hasn't changed much since September, when the Fed initiated its first rate cut of the year. Adding to this dovish tone, Powell also hinted that the central bank may soon halt the reduction in the size of its massive $6.6 trillion balance sheet. The mainstream media, from PBS to Investopedia, is interpreting this as solidifying expectations for further rate cuts, highlighting Powell's concern for employment and the challenge of navigating policy during a data-scarce period. Now, this is where Macro Shock really digs in. What does this mean for your money? To get a real-time pulse on market sentiment, I hit up Polymarket, the world's largest prediction market, to see what smart money is betting on. As of today, October 15, 2025, the probability of the Federal Reserve cutting interest rates by 25 basis points in October has skyrocketed to an astonishing 94% on Polymarket. This isn't just a strong signal, it's practically a certainty. Let's break down the scenarios. Base case, 90% probability. Fed cuts rates by 25 BPS in October, followed by another cut in December, and potentially one in 2026, alongside a halt in balance sheet reduction. This is overwhelmingly the market's expectation, driven by Powell's dovish comments and the perceived weakening in the labor market. Expect an initial positive reaction across the board. Lower borrowing costs translate to cheaper capital for businesses and increased consumer spending, giving a direct boost to corporate earnings. The S&P 500 and NASDAQ are likely to see moderate, sustained gains as the soft landing narrative takes firm hold. This could fuel further momentum into year-end. Specific market sectors. Technology, NASDAQ heavy. This sector is a big winner. Lower discount rates make future earnings appear more valuable today, directly benefiting high-growth tech companies. Software, semiconductors, and innovative tech firms should continue to outperform. Financials, a mixed bag here. While lower rates can squeeze interest rates, net interest margins for banks, the overall increase in lending activity, think more mortgages, car loans, and business expansion loans, could largely offset this pressure. Larger, diversified financial institutions are better positioned to adapt. Real estate housing. A direct beneficiary. Lower mortgage rates will ignite demand, stimulating home sales and construction. REITs and home builders could see significant investor interest. Consumer discretionary. Consumers with lower borrowing costs on their credit cards and personal loans will have more disposable income, boosting spending on non-essential goods and services. Major stocks. Keep an eye on tech giants like Apple, AAPL, Microsoft, MSFT, and Amazon, AMZN, to maintain their growth trajectory. In financials, watch JP Morgan Chase, JPM, and Bank of America, BAC, for their ability to navigate the shifting rate environment. In housing, Home Depot, HD, and Lowe's could benefit from a reinvigorated housing market. Bull case, 5% probability. The Fed aggressively cuts rates, e.g. 50 bps in Oct or 25 bps with exceptionally dovish forward guidance, accelerating future cuts due to a rapidly deteriorating employment situation. While less likely, this scenario would imply a more severe economic downturn that forces the Fed's hand even further. An immediate, sharp rally as markets price in significant stimulus. However, this could be followed by apprehension if the underlying economic weakness is perceived as too severe, potentially leading to a buy the rumor, sell the news dynamic as recession fears emerge. Specific market sectors. Growth, technology, would outperform significantly as lower rates drastically boost valuations for companies with long-duration earnings. High beta stocks would see the most dramatic swings. Housing, autos. These highly interest rate-sensitive sectors would receive an even stronger boost from deeply discounted borrowing costs. Major stocks. NVDA and Tesla could see outsized gains due to their growth stock nature. Home builders like D.R. Horton, DHI, and auto manufacturers like General Motors, GM, would benefit from a demand surge. Bear case, 5% probability. The Fed defies expectations, holds rates in October, or cuts less aggressively than anticipated, e.g. only one cut this year, possibly due to persistent inflation or excessive data uncertainty from the shutdown. This would be a major shock to market expectations. A significant market pullback would be inevitable. The S&P 500 and NASDAQ could experience sharp declines as the market interprets this as the Fed either being behind the curve on employment or overly hawkish on inflation, dashing hopes for lower borrowing costs. Specific market sectors. Technology, most vulnerable, facing significant sell-offs as valuations are re-rated downward under a higher-for-longer interest rate environment. Cyclicals, e.g. industrials, materials, could suffer from fears of an extended economic slowdown if the Fed is seen as not adequately supporting growth. Financials could see some relative resilience due to potentially higher net interest margins if rates remain elevated, but overall market weakness would still be a significant headwind. Major stocks. Tech giants like Google, GOOGL, and Meta, META, would face renewed pressure on their valuations. Industrial bellwethers like Caterpillar, CAT, and Boeing could see demand projections diminish. Banks like Wells Fargo or Citigroup (C) might see some margin expansion benefits, but the broader market sentiment would likely drag them down regardless. So, what's Dave doing in the face of this news? Given the overwhelming probability of a rate cut and Powell's clear dovish pivot, I'm cautiously optimistic. I'm definitely not selling into this news. In fact, I'm watching for opportunities. I believe the Fed's shift should provide a tailwind for equities, especially in growth-oriented sectors, as we head towards the end of the year. I'm leaning into quality tech and select consumer discretionary plays, but always with an eye on valuations. Now, let's look at the chart, specifically the SPY S&P 500 ETF. After a recent pullback, SPY is currently sitting right on a key support level of 650. This is a crucial line in the sand. If we see this support break, then the next levels I'm watching closely are 630 and then 610. Those would be significant retreats. However, to truly resume the uptrend and get back into a strong bullish posture, SPY needs to decisively maintain a close above 672. That's the level I'm eyeing for confirmation that the bullish narrative is firmly back in control. I'm holding my core positions, looking to add selectively on dips, especially if SPY can confirm that break above 672. But if 650 fails, that's a signal to tread with extreme caution. What do you think about Powell's speech and the Fed's apparent pivot? Are you bullish, bearish, or somewhere in between? Let me know your thoughts and your trades in the comments section below. And if you're getting value from this analysis, please do me a favor. Hit that like button, share this video, and if you haven't already, subscribe to Macro Shock and ring that notification bell so you don't miss our next episode. All right, folks, as always, remember this is not financial advice, just my analysis and perspective as a retail investor. Always do your own thorough research, consult with a financial professional, and understand the risks before making any investment decisions. Your capital is at risk.